Hi, everyone, and thank you for joining us. We're excited to welcome Ian Murphy, the founder of Murphy Financial Training. Ian Murphy offers education, analysis, and tools to traders. He is the author of Way of the Trader, a complete guide to the art of financial trading, which has been published in the US, UK, India, and China. And we're very excited to welcome him here today. Mr. Murphy, thank you for joining us. The floor is yours.
And thank you very much, Stephen, and thank you to the Money Show for having me today. Okay, I've quite a lot to get through in the next 30 minutes, so let's make a start here. First of all, I'd like to draw your attention to my standard disclaimer. Content is provided for information only and education is not a recommendation to trade. Trading is not suitable for everyone and involves the risk of losing money. Past performance is not a reliable guide to future returns. Okay, hopefully this afternoon we'll have time for Q&A at the end. We'll just have to see how it goes. But if you do have any questions or you would like a copy of this presentation, make sure to drop me an email. It's ian@murphytrading.com. Okay, tonight's or this afternoon's presentation is about how to monetize market moves. But first of all, I think it would be very helpful to understand what actually is a market move, because people have different understandings of what it is. You know, with the risk of stating the obvious, monetizing market moves should be the core mission of every trader. If we're not making money from market volatility, which is a market move, then we have to ask ourselves, what are we doing in the market? And that sounds simple in theory, but the challenge arises because the market is always moving at different speeds and in different directions. And grabbing part of a move with invested capital on a consistent basis is a lot more difficult than it appears. Because any financial instrument, be it a stock or futures or a Forex pair, can move quickly and then reverse before we can bank the profits. Or it can be in a long, slow trend which kind of goes unnoticed by us. And before we know it, behind, missed the market move. So what is a move? If we're trying to grab these moves, let's see if we can understand or define what exactly a move is. And the first question that comes to mind when I work with traders, both new traders and more experienced traders, is what's the difference between normal market noise and a market move? And the answer to that is very simple. It depends on the time frame you're trading. And the time frame you're trading will be dictated by your preferred trading style and the strategies that you've chosen to employ within that style to capture market moves. So for you, a move will all depend on the time frame you're trading. That could be a favorite time frame that you consistently trade, or you could switch between time frames. But the first port of call is to get a market move, you need to know and understand the time frame you're trading. We can trade monthly charts, weekly charts, daily or day charts. All of these have market moves and market noise happening at the same time. The most important takeaway here is your style defines your market move. So the market move that you're trading is specific to you at this point in time that you're invested in the market. And it doesn't matter whether you're string trading or trend following. It's your style defines your market move. It's unique and specific to you. And for this reason, market noise, which is just the daily up and down, back and forth of the market noise for a trend follower is actually a tradable move for a swing trader. So trend follower is ignoring market noise, but it's exactly what a swing trader is looking for. This is the move he needs to profit. And then if we go down another time frame, market noise for a swing trader is actually a valid move for a day trader. So we can see from this, the shorter the time frame we're trading, the more moves will occur. Now there's for and against that, because the more moves that occur, it could be, you know, depending on your perspective, the more opportunities you have, but at the same time, it could be the more problems you have. So I suppose to give a technical description to a move, I would refer to it, and I think most people in the trade would prefer to it as realized volatility. And traders need the opportunities that volatility offers in order to profit. If a market isn't moving up and down, if it doesn't have realized volatility, we cannot make profit on short-term moves. So to go back to where I originally said that our core mission should be to monetize market moves, a trader's job description emanating from that is traders monetized realized volatility in liquid financial instruments. And this is what we should be doing when we're engaging with the market. So I kind of classify moves into two categories, and let's just briefly have a look at them. First of all, there is what I would call a defined move. And if you look at this screen grab on the bottom, if you can see here, we have a defined move entering here at $34, closing out here at $42. This move was defined from the entry. If it was going up to 42 here, the trader was getting out. So your entry and your exit price are clearly defined in advance, as we can see here in this screen grab. What happened here before we traded and what happens afterwards is irrelevant. This move is what we were trying to capture. It was defined in advance before we entered the trade. Both your entry and your exit can be based on price targets, or they can also be based on technical levels. So a just quick glance at this chart. This is actually AFL stock. Was oversold here. It's 3 ATR channel. We had a bounce, formed a sort of a messy first higher low, and then we pierced straight through the 3 ATR channel. So this trader went from value to an overbought condition, or excuse me, oversold, and took his profit there. That's the technical levels on that one. Again, these defined moves can happen on monthly, weekly, or daily intraday timeframes. And defined moves tend to be more common with swing trading strategies like this, where the market reversed here and we swung up. This is where you tend to see defined moves more. Our exit will always be from above because we've an order sitting up here and we hit it from underneath. Now, that's obviously on the long side, and the reverse will be the opposite, will be the case for shorting. But you're going to hit your target from underneath or from above. The risk-reward ratio on any defined move needs to be at least 2 times or twice the distance in dollars, the price in dollars between your entry and your stop. Preferably, you're looking at a risk-to-reward ratio of 3 to make your strategy profitable. And then the final point on a defined move is what happens after the event is irrelevant. All of this doesn't matter. We took this, that's what we wanted, and that's it. So that's a defined move. The second type of move I would say is a kind of an open-ended move. And here the entry is okay, but there's no clearly defined exit or fixed target. And as you can see here, this was a trend following trade. And we didn't exit here at this point as we did in the defined move. We just stayed with this until we were actually stopped out here at $43.54. And you can see the exit, this was determined by the trailing stop. When we hit it from above, we came down and came through the stop. Again, you can get your open-ended moves on monthly, weekly, daily, or intraday charts. And moves applied to following is primarily like this one. Exit will be from below. You go up, and when you pull back, you have a stop, protective stop sitting here, and it triggers, and you're out. And that's how you get out. And obviously then this is for the long side, and on the short side, the reverse applies. Risk to reward ratio adjusts as the trade unfolds. When you initially enter here, you're going to have a risk to reward setup, which should be 3-to-1. But then as this moves, and let's say you're up here, the distance between the current price and your protective stop, you may need to reduce your position in order to get back into your exposure that you require. And then you're on a pullback where you recover, you can scale back in. So you can reduce and increase your position as it goes. And then finally, the theory with the open-ended move is you just try to catch as much of this long-term trend as possible, as you can see here. So those are the types of moves. So let's look at, there's 2 ways I would say that you can monetize these moves. First of all, you carry a full position. And what that means is you enter a trade and you, let's say you buy 1,000 shares and you continue to hold those 1,000 shares until you exit. It's stopped out, or you just take a manual exit, whatever. And the idea is you get a lump sum when the trade is closed. The downside of that is you're exposed to a larger risk in the market. You carry the risk of the entire 1,000 shares for the entire time you're exposed to risk in the market carrying that trade. The advantage is you'll gain more because you're compounding the profits as you go. Another advantage of carrying a full position is it's easier to manage that type of trade because you've only got two orders, remember. You're open and stop. You've only one stop, protective stop, to manage throughout the entire process of the trade when you're carrying a full position. Carrying a full position is also kind of an all or nothing thing. If the price reverses, any paper profits that you had throughout the trade can instantly evaporate. And you can end up going from a very profitable situation to a loss-making situation because you haven't taken any money off the table if you decide to carry a full position the whole way through. Another kind of thing we need to bear in mind when carrying a full position in the trade is we must trade solid and liquid instruments. Because remember, your trade is only as good as when you're trying to get out, and that's what matters. And you need to have the solidity and the liquidity in the instrument you're trading to ensure you get a fill at your price without slippage when you decide to exit the trade. If it's a profitable trade and you have compounded as you've gone, then you're going to have a much larger position in dollars to exit than when you entered. And you need to be sure you can fill the order when that day comes. Like we say, as the position grows, it'll be harder. It may be harder, depending on the size of your account, to get a good fill on exit. And you should always be aware of liquidity in instruments. Liquidity being the price of a stock, if you are trading equities, multiplied by the volume. And you should follow what I call the 5 limits of risk and ensure that your position size is never too large for the instrument you're trading. A disadvantage of carrying a full position when we're attempting to monetize market moves is that you can have a jagged equity curve. And what that means is that your equity will take a sudden jump up when you close out a position or take a sudden jump down when you don't. So that's the first way I would kind of see as managing positions to monetize. Second is scaling out in fractions. And this is something I tend to do more. The advantage of scaling out of a position is that we limit our exposure by receiving sort of stage payments as we go, as the trade progresses. We're locking in profits as we go, just in case the market reverses, takes out our position, then we won't lose these paper profits. They'll be realized profits because we've banked some in stage payments as the market moved in our direction. You can also take greater risk because if you scale out part of your position in fractions, you'll be left with a small fraction, maybe 1/3 of your original position on your final portion of the trade, and you can increase your risk. If you're in a trend following trade, for example, and you've scaled out and you've just a small position left, and then you get a nice pullback and the trend continues as before, there's no reason you can't scale back in again and increase your position and then scale out again. And the other advantage of scaling out in fractions is it smooths your equity curve. You get regular incremental gains in your account. That's particularly important if you're managing money for others, because investors like the security and comfort of seeing regular income rather than large jumps in equity, which are always exposed and always at risk until you close out the account, or until you close out the trade, excuse me. And then finally, before we get into charts, let's have a look at how to measure a move. How do we know where to scale out? I use a technical indicator called average true range. And this is calculated from the current high, the low, and the previous close of a price bar or a candle. And what it does is it looks at the range, which is the high and the low of price bars. And because we're incorporating the previous bars close, it captures gaps between the close and the open in price bars. And ATR, average true range, is a measure of realized volatility. If you can see here, what it does is measures how much the price moves up and down the price axis. It's kind of like a seismograph or a heart monitor. As it's scratching up and down, this height, relative in percentage terms to the price of the stock you're trading, that is the realized volatility, average true range. Like a lie detector or seismograph. Instruments, financial instruments now, not seismographs, move from periods of low to high volatility. And this often kind of surprises people because we know the market goes through various cycles, bullish and bearish cycles, and risk on and risk off, and all this type of thing. And it alternates between trending and not trending. But it also between low and high volatility, where this upward and downward movement of price compresses and then all of a sudden it explodes upwards. And this transference from low compressed prices to high volatility, it's one of the things I use in one of my favorite daily swing trading strategies. So in answer to the question here on this slide of how to measure a move and where to scale out, I scale out after a 1 ATR move to from where I entered. So if I'm trading long and I enter here at 80, after 1 ATR move to the upside, I scale out part of the position. If I'm trading short and I entered at 80, I'll scale out part of the position after a 1 ATR move to the downside. And then I will continue to scale out after successive 1 ATR moves, provided the ticker's moving in the direction I want. Now, just before we get into the charts, if you want to know some more about ATR channels and protective stops that are calculated from average true range, like this one you see on here, this red stop, this is an ATR volatility-based protective stop. You should check out the video or the presentation I did in the Money Show last March 2020. If you go to the Money Show website and just search under my name, you'll see a video on there where I demonstrated how these ATR-based trailing stops work and how I calculate them. Okay, so that's the theory of monetizing market moves, and those are the PowerPoint slides. But as we all know, things can be a lot more challenging in real life trades, and when we're in the market and when there's real money at play, it often doesn't go to plan. So now let's take a look at some charts where I can show you examples of how we monetize these market moves. And I also want to share with you some recent trades where I caught defined moves and open-ended moves while carrying a full position, and then also while scaling out of positions. Okay, market moves, Exhibit A. This is oil futures. I took this screen grab at 7 a.m. this morning, Eastern. On here, I have price bars which change color based on Elder impulse. This is an indicator from my friend, Dr. Alexander Elder. No doubt you're familiar with Dr. Elder's work. And when MACD histogram and a moving average are in sync, these bars change color, and they're a wonderful trend indicator. On top of that, I have 3 ATR channels, if you can see them here, 1, 2, and 3. And these are set at a 1 ATR distance above and below this central 21 period exponential moving average. Because we're on a daily chart, this is going to be 21 days, 21 trading sessions, not calendar days, obviously. And that's trailing stop, and then the MACD histogram volume and them, they're not really relevant in this example. So oil, as you know, this is in the news today. Production cuts recently in Saudi Arabia attempting to support the price. And of course, we have the big freeze in Texas, which is supporting prices. My big hello to my friends and family in Austin. I hope you're doing okay. This is a daily chart. This trailing stop is set on an intraday basis. And what that means is that if the price pierces the stop where my order is sitting, the position will be closed out. Doesn't matter when it hits it, so long as it's during the regular trading session. And the stop on this is currently at 57.30, which is based on yesterday's session close, because these are futures. And this really is a very good example of an open-ended move, which is monetized using an ATR-based trailing stop from the lows of the price bars. And oil futures are up 80% since November 2nd, and the trailing stop caught the whole thing. Exhibit B, S&P 500 futures. This is a weekly chart. These are E-minis. If you look here, same thing, trailing stop. If you look here at the pullbacks we had in September and October, they were shallow, but they didn't pierce the trailing stop. This bullish move in US equities is almost a year old, and the trailing stop caught it perfectly. It's loose enough to catch the trend, but tight enough to stop us out and lock in profits if we have a sell-off here, for example, at the moment. And this is a perfect example of a simple method of how to monetize a long-term move in US equities. You don't have to sit at the screen all day. You only have to look at the market on Friday afternoon or Friday night when the futures stop trading. And that's it, because this stop is based on a weekly closing basis. And what that means is that if the stop is pierced intra-week, you don't close the order. You just look if the bar, these are weekly price bars, close below the stop, then you manually close out the position on Friday afternoon. And that has not happened since we entered back here in March. Then after that, the only thing you have to do is make sure to roll over these futures contracts close to expiry. And you could also trade this on an ETF, such as SPY. Okay, that's kind of demonstrating the stops. Let's now take a closer look at some recent trades in my own account. Left-hand side here, we have Omega Healthcare. This is a daily swing trade using my digital strategy. You can see here, I bought 600 shares on, that's January 20. So the two defined moves to the upside from my entry point were 1, 2 ATR move to the upside. And you can see that I scaled out 200 shares, which was 1/3 of the original 600 position on January 28th here, after the first target was hit. But then I sold the remaining 400 because we were coming into earnings. And earnings happened just about here. So I scaled out one, closed out the second. We had earnings, didn't really affect the price, didn't make much of a difference, but pulled 1.6% profit out of that. Then another recent trade here, Unity on the right-hand side, Unity Software, symbol is U. On this guy, I bought 120 shares on January 21st. I did have an opportunity to scale out at 2 ATRs on this. So on the following day, 22nd, I scaled out, and then on the 25th, I scaled out. This was after two defined moves to the upside. And then I closed the final 1/3 of the position here on February 2nd, just before earnings. And it's just as well because you can see earnings came out, gap down, and we're now in a bullish trend. So here you can see an example of how I pulled 6.3% profit out of this in a week and a half, 2 weeks run up to earnings by capturing these defined moves and by scaling out. If I hadn't done that, if I'd bought here and stuck with it, now I'd be sitting on a loss. Next up, we have what I call scale and trail. And what we're doing here is we're scaling out parts of our initial position and then trailing a stop under the remainder. This is a kind of a hybrid method. And on here we have the SSO 2x geared ETF, which tracks the S&P 500. And if you can see just above the pointer here on the left-hand side of the chart, I bought 600 shares on June 30. Then I scaled out 1/3 of that position here after one ATR moved to the upside. Then I scaled out another third here on July 13. And then I trailed a stop this whole way with the remaining position until I was stopped out here on September 3rd. Then if you look on the right-hand side of the chart, sorry, I got 12.2% profit on that based on the original size of the position. Right-hand side of the chart here, bought 800 shares on November 3rd. In this case, the following day, I just sold 1/4 of that position, which is 200 shares. Because we had our 1 ATR move to the upside, at that point, I was happy that I was in a break-even position. I was more comfortable. So I decided to hold the remaining position the whole way up on this trailing stop. Then at this point here, I bought back 200 shares. This was December 10 and a pullback. And then I was stopped out here of the entire 800 shares I was holding on December 21st. And then there was 9.8% profit on that based on the value of those two purchases. And finally, if you can just make out on the very right-hand side of the chart here, it's a bit small, apologies, but you should be able to see it. I bought 1,000 shares here on This was December 28. And then I closed out that full position here on New Year's Eve for a small loss. The reason I did this is I didn't have a 1 ATR move to the upside, which didn't put me into a break even or close to break even position. I also didn't want to be in a position where I was carrying 1,000 shares over a long holiday weekend. And just as well that I did close out here, because the first day back after the holidays on January 4, I would have been stopped out because straight down through any reasonable protective stop. And that's where we went. Okay, and I made a small loss on that, I think 0.1% or something. And final chart I want to share with you this afternoon is, this is a trade I just actually closed out today. And I want to show you this because not all trades, not all market moves, well, can be profited from, if you know what I mean. And I just want to show you one that didn't work out so well, just to give you a bit of balance. This is a daily swing trade in Element Solutions. Ticker here is ESI. On the left-hand side here, I bought 1,200 shares on February 11. You can see here. And you see the way I have the orders set here to scale out? 1,200 shares. My initial protective stop was down here based on my position sizing. And the idea was if I get a move here to 1828, I'd take 400 shares being 1/3 of 1,200 off the table. A second ATR move, scale out the second, and then I would have let the stop run under the rest of it and just kept shoving up that order. Didn't quite work out like that. This is a screen grab I took today. After 3 days, there was no movement on this. It didn't pop. And this diesel strategy I use, which is a change in volatility, and these price bars, they change color based on a price squeeze, what I call a diesel squeeze. It's when volatility reduces and you get this compression in prices before an explosion to the upside. This diesel strategy is designed to catch a market move, and it happens quickly and explosively, or it doesn't happen at all. So it's not going to happen in a few days, it's just not going to happen. So yesterday, when we had a little bit of a sell-off yesterday, I moved the protective stop on this to break even, which was because we had just enough move to the upside to allow me to do that. And then I was stopped out at the open this morning at 9:30 Eastern. I took a loss of 0.4% on this. I took this screen grab just at lunchtime. It had sold off even more down through any sort of protect stop I would have had. So it then started trading close to where the protective stop would have been. So 0.4%, not bad, avoided a bigger loss. If I had been in the original initial stop and hadn't moved up a protective stop yesterday, I'd be sitting on a larger loss. About 1.25% is what I risk on normal trades. That's kind of the normal course of events. Okay, there are the charts. How are we doing on time? Not too bad. I just want to share two final thoughts with you on monetizing market moves. First one is, if you're not in, you can't win. And when I speak to traders, and kind of some traders this year are frustrated that they haven't caught a lot of the move that has happened so far. And then when you look at their account and analyze the percentage of their account that they had invested and how much money had they in the market, they may have been following the market and tipping away at little bits of trade, but in percentage term, how much money had they invested? Not a lot. I know it seems obvious, but sometimes it's the obvious things are the simple ways to gain. You can only monetize market moves by having money in the market. If you're not in, you can't win. And if you're not in the market and you're holding back because you have an aversion to risk, this is something to be aware of, because what you actually have is an aversion to trading. How do you deal with this? Very simply. Identify the opportunities, like I showed you in the previous trades, those squeeze conditions and those trends. Manage your risk by using proper risk management formulas, and then just go for it. That's what we're at. You have to take that risk, but you have the comfort of knowing and the confidence when trading that your risk is managed. And the final thought I'd share with you is the preservation of capital. We can only monetize market moves if we have money to begin with. And if you're losing your money in big bites or small, slow trend, then you cannot monetize the big moves when they come. You have to preserve your capital. And this brings us to the golden rule of trading, the preservation of capital. If a trade is not working out, get out and do that getting out quickly. Run for that exit fast. Don't stop to pick up anything. And that's like I showed you in that trade there a minute ago. I closed that out quickly. That's how to trade it. And finally, I would say always use a protective stop. This will get you out of so many problems. I never ever trade without a protective stop. And when working with traders, those who are not making money because they're not invested, the other issue that comes up is they were not using protective stops, or worse still, they had a stop and they moved it. I never move down protective stops. Okay, we're bang on. That's it for this afternoon. Thank you very much. If you have any questions or you would like a copy of the presentation, drop me an email. There's the email address. You can also find me on social media. And I regularly do posts at the blog on spiketrade.com. You should check that out. So just to finish, I would like to say thank you to the Money Show for inviting me on again. Thank all of you for attending. And I'll bring it back to you now, Stephen.
All right. Thank you, Mr. Murphy. That was a great presentation. We really appreciate your time today.
You're more than welcome anytime. Thank you.
And as a friendly reminder to everyone, if you'd like to replay sessions on demand, please visit virtualpass.moneyshow.com.